In this video, I'll explain the theory behind stock buybacks, what they are, why companies do this, and the implications it can have on shareholders and the business. So, first of all, we need to understand what a stock buyback actually is. As the name would suggest, it's when a company buys back some of their own shares currently available on the market using their cash reserves. Since a company can't be its own shareholder, repurchased shares are either cancelled or are held in the company's treasury. Either way, the shares are no longer available on the market. So why do companies perform stock buybacks? There are a few reasons why a company would initiate a stock buyback. One reason would be to signal to the market that a stock is undervalued. If a company's management believes that the company's stock is undervalued, they may decide to buy back some of its shares from the market to increase the price of the remaining shares. Naturally, as a company buys back a large portion of shares and effectively takes them off the market, this reduces the number of shares in current circulation. And as supply and demand dictates market prices, the demand increases as the shares become rarer to acquire, which ultimately drives up the share price. Secondly, it could be to distribute capital to shareholders without actually paying a dividend. Dividend payments don't provide a lot of flexibility to the company's management, since they have to be paid on certain dates, and all shareholders must be paid. On the other hand, stock buybacks generally provide more flexibility, as they don't have to specify the amounts that must be paid or the dates when the payment must take place. And thirdly, it could be done to absorb the increases in the number of shares outstanding due to the exercise of stock options. Companies that offer stock options as part of compensation packages to its employees commonly initiate stock buybacks. Stock options basically give the employee the right to buy the company's shares at a specified price for a finite period of time. When the company's employees exercise their stock options, i.e. buy the shares, the total number of shares outstanding in the market increases. So, in order to counteract this increase, a company buys back some of the shares currently available on the market. There is a lot of debate surrounding share buybacks and whether they are actually beneficial for shareholders or whether they just create a false portrayal of the company. To illustrate this, let's look at the effect a share buyback can have on a company's EPS, or earnings per share. Earnings per share is an important metric that investors use to evaluate a company's financial position. To calculate a company's EPS, you would divide the total earnings of the company by the number of outstanding shares, where a higher number indicates a stronger financial position. By repurchasing its own stock, a company decreases the number of outstanding shares. A stock buyback therefore enables a company to increase its EPS without actually increasing its earnings or doing anything to support the idea that it is becoming financially stronger. Let's further illustrate this with a working example. Imagine a company decides to buy back 1 million of its outstanding 10 million shares at $20 per share for a total cash outlay of $20 million. And let's have a look how that changes the financial metrics of a company. As you can see, the company's cash has been reduced from $30 million to $10 million. And because cash is an asset, this will lower the total assets of the company from $50 million to $30 million. The earnings remain unaffected. However, the return on assets increases, even though earnings haven't changed. A similar outcome can be seen for EPS, which increases from 20 cents, $2 million divided by 10 million shares, to 22 cents, $2 million divided by 9 million shares, which would make it more attractive to investors, even though again the company hasn't done anything meaningful to justify this. According to a Harvard Business Review, more than half of corporate profits in the US go towards share buybacks. Some economists and investors argue that using excess cash to buy up their stock in the open market is the opposite of what companies should be doing, which is reinvesting to facilitate growth, as well as job creation and capacity. This claim is backed up by US Senators Chuck Schumer and Bernie Sanders, who argue that when corporations direct resources to buy back shares on this scale, they restrain their capacity to reinvest profits more meaningfully in the company in terms of research and development, equipment, higher wages, paid medical leave, retirement benefits, and worker retraining. An example of this would be to look at Walmart. Walmart is a company that have initiated regular share buybacks and announced mass redundancies of its staff in 2020, yet still found enough capital to purchase $2.074 billion of share buybacks during the year. It begs the question, was that really the best use of company cash to drive the business forward? Before 1980, buybacks weren't all that common. More recently, they've become far more frequent. We can see this on the graph, where the last 10 years have seen a considerable increase since 1998. In fact, between 2003 and 2012, the 449 publicly listed companies on the S&P 500 allocated $2.4 trillion. That's 54% of their combined total earnings towards share buybacks. It's become commonplace in many businesses and something that I feel you should monitor for your own personal portfolio. Share buyback programs have always had their advantages and disadvantages for company management and shareholders alike. But as their frequency has increased in recent years, the actual value of stock buybacks has come into question. Some corporate finance analysts believe that companies use them as a deceitful method to artificially inflate certain financial metrics, such as EPS, under the guise of providing a benefit to shareholders. I think it's important that investors don't judge a stock based solely on the company's buyback program, though it is something worth looking at when you are considering investing. A company that repurchases its own shares too aggressively might well be reckless in other areas, while a company that repurchases shares under only the most stringent of circumstances, such as an unreasonably low share price, is more likely to have shareholders' best interests in mind. I hope that you've enjoyed this technical investing video and taken some value from it. If you have, then please like the video and subscribe to the channel to make sure that you don't miss any future videos. Also, let me know what other topics you'd like me to explain in the comment section below. Thanks again for watching, and I'll see you in the next video.